For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, thank you, me, or thank me, you. I don't know. Nice intro. Managing Your Financial Future, your podcast. Johnny Dean, your podcast host. And boy, oh boy. So Professor Rick Plum, by the way, certified financial planner, professional, and accredited wealth management advisor. I got to get that in right away. Welcome. Nice to have you here.
Thanks, sir.
So I was, we were talking in the last episode about, I mentioned something about, we were talking about 401k, and I mentioned that back 20 years ago, there was a big push, and it didn't last long, but a big push to buy real estate with the money using your 401k. And there was a specific name for it. I don't recall it, and I wouldn't say it anyway, because it was
stupid.
It was stupid. It was basically worthless, and a lot of people who did that. Boy, can you imagine if you bought real estate with your 401k in 2006?
Yeah.
I mean,
well, I bought real estate in 2005, so I know exactly what it felt like for a couple of years after that.
Well, you bought, but yours was a personal residence, and you're still there. I think,
right? Yeah, but
it's the same home.
It still stunk. I mean, it felt
sure.
bad. I mean, you put 30-40% down, and you end up underwater 3 years later.
Well, that's what happened, and it takes forever to come back. But can you imagine if you had used the money in your IRA or your 401k? So anyway, I got thinking about that after the episode. It just popped into my head as I was doing a little bit of research here, and I had somebody had sent me this. It didn't come to me, but it came to somebody I know, and they had sent me this email that they got, and this was a while back, not too long ago though. And we haven't heard this we haven't heard this for a long time. And so I want to bring this up and talk about this on this program, about buying real estate. There are benefits to owning real estate personally, but there are some people who say, well, gee, I've got real estate to sell, and the money's in their IRA. So let me see if I can convince somebody to do this. So,
well, going back to 2005, the reason there was a huge push because to buy real estate in the IRA specifically was because real estate was on fire, and the real estate agents were running out of people to sell to because most of the money of the people they were coming into contact with, the money was in IRAs. So they had to find a way to make a sale, and the money's in the IRA. Let's find a way to make the sale in the IRA.
That's right. Go where the money is. So here's the email. I'll just read this very quickly. It'll take 20 seconds. Dear such and such, have you ever considered using your IRA to invest in real estate? It's one of the most powerful and underutilized strategies to grow your retirement wealth with real assets. With a self-directed IRA, you can buy rental properties, earn passive income, and enjoy long-term appreciation, all tax-deferred. Imagine owning cash-flowing property inside your IRA, completely separate from the stock market. Let me know if you'd like to talk more. And then that was the letter. That was the email. Every sentence is fraught with problems.
And as an investment, I have no problem with what he said about real estate. You know, having a non-correlated asset to the stock market, cash flowing real estate with some appreciation. All these things are great and can be very good investment decisions for some people as they go along. Buying it inside of the IRA is where things get very wonky.
Well, I think what you meant to say was it's a really dumb idea.
It is, because if I am going to buy, now first off, I cannot buy my primary residence or a vacation residence. I cannot buy a personal use property in my own IRA.
Yes. Now
I can only buy investment property in my IRA. Fine.
Yes, let me run these down, because I jotted down some notes, and I want you to address them each individually, and that was one of the things. But first thing I'm going to bring up, there are 3 or 4 points on this, and you can comment on this, and then we'll have we'll have a overarching theme here in a little bit. But first reason not to do it that I could think of was it's certainly not as simple as people make it sound. You need self-directed IRA. Your custodian may not offer it. You have to follow rules. Just in general, Professor, address that, if you will.
Well, you have to find a specific custodian. An IRA has to have a custodian. I know they're these self-custodian ones, but there's supposedly a custodian there beside you. You have to have a custodian that allows you to purchase real estate inside of it. A typical brokerage company is not going to allow that to happen because they don't have any control. They don't have any way to get paid for it. So it has to be a special real estate IRA custodian. And typically they're not free. And every time a check is received or a check is sent for maintenance or whatever, every time something happens, a transaction occurs, that IRA custodian usually charges a fee. I mean, it may only be $5 or $10 for a check received or a check written, but it's $5 or $10 for every check received or check written. So they can be fairly high in fees. So, but you have to have a specific IRA custodian that is not a traditional IRA custodian. Your bank typically won't do it. It's going to be a high-end trust company or something that is not your run-of-the-mill. It's not going to be the Fidelity, Vanguard, Schwab, the ones that the TD Ameritrades, whatever. It's not going to be the $5 trade or zero trade cost. It's not going to be the cheap, free type IRA custodian.
No, and that should be a big one right away. That should be a little bit of a red flag. But okay, so it's not simple. But now here's, I think, what you started to say. Another problem with owning real estate in an IRA or 401k for that matter, solo K, you or your family members, you cannot use this personally. You can't use it as a vacation. You can't use it as for work, even for free. And this, as I understand it, you cannot use it. Your spouse, your parents, your kids, even contractors you might hire, you can't use it. So nothing personal in this.
It has to be investment real estate, and it has to be treated completely like investment real estate. There are some custodians that say you can live in it, but you have to pay rent to it. And that's just another way to get money into the tax-deferred world. It's not deductible to you at all. Your rent isn't deductible, but you're building up your IRA for the future. That's not exactly what I think is the best use of the money anyway, but that's still self-dealing. You're buying and renting from yourself. In some respects, that's the way they're going to look at it. So anytime you're dealing with a vacation home, a primary residence, or a personal use asset inside the IRA, it's called self-dealing. And if caught, they could disallow the entire IRA. Now, what does that mean? The value of whatever's in that IRA becomes taxable in one lump sum at that point, which becomes very ugly, very quick.
Absolutely. I mean, if you've bought it, you probably have, mid six figures. You got a large one, and the entire IRA could become taxable.
Most real estate isn't $5,000 and $10,000, is it? Not really. Most real estate properties anywhere in the U.S., you're talking $300,000, $400,000, $500,000 minimum almost.
No, not unless this broadcast is going back in time to 1952. So no, it's not. So those are prohibited transactions, and that could render the entire IRA taxable. Now, here's something else. Another problem with owning real estate in the IRA, and a lot of people don't know this, but all expenses with the property have to be paid from the IRA. We're talking about taxes, repairs, insurance, HOA, property management. I mean, everything. You cannot come out of pocket, right?
All cash flow has to go from the rental property, has to go into it. All expenses for the property have to come out of the IRA. It can't be paid for personally. I know an individual who had a rental property in their IRA, and they paid for a $20,000 or $30,000 repair, and just because of expedience and they couldn't find the right checkbook or whatever they wrote the check themselves. That is basically a contribution to the IRA because the IRA technically paid the expense. How did the IRA get the money? This individual transferred the money into the IRA. That's a contribution to the IRA. Gentleman wasn't working. He didn't have the ability to make a contribution to an IRA. Plus, even if he was, the contribution limits are way less than the $25,000 he paid. So that is now an excess contribution that carries a 6% penalty for as long as he leaves that money in there. So if he did it just one day and then he pulled the money out the next day, it probably wouldn't get caught. And it's also now he's corrected the distribution or the contribution, so it should fly okay. But he wasn't planning on doing that. He just paid it because the IRA didn't have the money, the cash available in the IRA to make the repair. There was no cash there. They'd already spent all the cash, that the ongoing cash. It was, and so he just paid it. If it doesn't happen, I got to do it. And so that can be a problem.
It can
I
be
saw
a problem.
somebody do it with a property tax bill. The IRA didn't have enough money to pay the property tax bill, so they paid the property tax bill. That's that's an excess contribution to an IRA.
I got to think that happens a lot too, because somebody who says, "Well, I got $500,000 in my IRA. Why don't I buy a $510,000 property, or a $490,000 property?" Something like that, and the IRA will own it all. There's no loan on it, which is another problem.
Which should be cash flowing, so there should be cash there for future needs. But immediate needs, you want to make sure that whatever you're buying, you have enough cash to cover all the expenses that may come up between now and when you get your checks, or not when but when the IRA gets its rental checks.
Well, and you know what happens with rental properties often, investment properties, they always have some issue, and you don't know. There could be a big plumbing problem, or a roof needs replacing that you didn't know. Anyway, it's just, you got to be careful. All expenses have to be paid from the IRA, or you're going to have a lot of penalties on this. So that's another, just one or two more here before we kind of talk about another aspect of this. I won't bring up UBTI, which is unrelated business taxable income, because that's a whole other thing. But that would
put me to sleep, even with me talking about it.
Yeah, I know. If you have a mortgage and all that stuff, any income. So we'll leave that off. But here's the big reason, I think, that you don't want to do this. The three others we gave you are reason enough. But the tax benefits of owning real estate pretty much are gone when you own it inside of an IRA. I mean,
well, a lot of people buy real estate for the current tax benefits, the ability to shelter the cash flow that they're receiving from that through the use of depreciation, the ability to get long-term capital gains tax treatment when they ultimately sell it. And so you lose. Those are the two biggest ones. You lose those two, the current and future tax benefit. You do get tax deferral. That is a very true statement. And so it is tax deferred, but it's tax deferred at ordinary income. And if I really do really well, it becomes part of my overall IRA for required minimum distribution purposes that I have to then calculate the RMD based on the total value. And that means I need to start having valuations done once I'm 73 or 75 to show the value of my property to base the RMD on. And hopefully the cash flow is high enough to satisfy that the net cash flow after all expenses are paid is big enough to be able to pay that. And so it's a matter of you lose the current tax benefit of the the sheltered income. You lose the long-term capital gain treatment. You lose the step-up in tax basis that you have if you happen to hold it long enough, or you die while you own it. So you bought the place. I was talking to a lady this morning, and she paid $180,000 for a condo in San Diego, and they're thinking about selling it for $1 million because they can. And they were looking at, so what's our tax consequence? And it's like, well, it's going to be a sizable number.
Big.
And they're saying, and it was a lady and her mom that owned it, and the mom is 80 years old. And she goes, well, what if I take my name off of it and just let my mom own it for the next 10, 15 years, and then I inherit it? I don't know if that fits into your goals today about what you're trying to do, but in that respect, the capital gain goes away. But if it's in your IRA, there is no step up in tax basis. Now, a lot of people look at real estate. One of the reasons that people like real estate, I'm going to change gears on you just slightly, John, is that they can get into a $500,000, $600,000 property without having $500,000 or $600,000. They can get into it with maybe $100,000. They put 20% down, 25% down, and if they can make things work, the rents, they'll cover the cost of the mortgage and the property taxes and the homeowners association and all the fees, and they'll basically be break even-ish. They don't have to feed it much, but so they can get a potentially $500,000 asset appreciating using leverage. And leverage can really enhance or cripple the return that you have as a real estate investor. Leverage is where people make the money for the most part, especially in the early years of real estate. Because if that property, that $500,000 property goes up 5%, that's $25,000. But my equity went from 100,000 to 120. That was a 25% increase in my equity. And so when you're doing that now with real estate inside of an IRA, it's much more difficult to do that for a couple of reasons. One is the IRA by itself, without you as a cosigner, has to qualify for the loan. So if all you have is $150,000 in the IRA, you're not going to get the best loan in the world, because what income does that IRA have? Now you have to show that this rental property has the strength to be able to cover that. But so they're making this loan just on that one asset, not on you, not on the fact that you make $200,000 or $300,000. You cannot co-sign for it, because what happens if the IRA defaults? You can't make a payment. That's a contribution to an IRA that you're prohibited from making. So they don't like you do that. The other thing is with debt inside of an IRA. In this example, I put $100,000 down. I have a $400,000 mortgage. It appreciates to $700,000, and I want to sell it. I want to capture that $200,000 gain inside my IRA. I won't pay any taxes on it, but that's not a true statement, because the percentage of debt that's on it when I sell it, at this point it may be only 17% or 73%, because it's gone up. The gain attributable to the debt. So the 80% original, now it's 70% of the value is debt. That's a taxable event. So if I had a $200,000 gain and it was a 70% event, $140,000 of that $200,000 gain is taxable to the IRA in that year. The IRA is going to have to file a tax return. And what are the tax rates for an IRA? Are they a single individual? No. Are they the better ones for a married couple? We're married, we own it. Nope. They're the trust tax rates. And the trust tax rates hit 37% at about $15,000 of overall income. Whoa. So the majority of that gain is going to be taxed inside the IRA. You don't personally pay taxes on it. It's tax deferred to you. But the IRA pays taxes on the debt financing portion of it at a very quickly 37% tax bracket. So the loan's harder to get, and unless you pay off that loan before you sell it, you're going to get hit with debt finance taxable income. So that becomes ugly, and that's a big surprise to a lot of people. And so now it doesn't mean you can't use the money in the IRA to buy the real estate. If you're dead set on it, there may be a way to make it work. The idea is to figure out a way to still own it personally. I'm going to buy it personally, but I don't have the money, Rick. It's in my IRA. That's okay. The thing is, you got to come up with a down payment on your own somehow. And then you use the IRA to take a distribution to help you pay the loan on the difference. So you get first get $100,000 for the down payment, and then you take the $400,000 loan, and then you start taking a distribution from the IRA, which is a taxable distribution, to pay the loan payment. But the depreciation and all the benefits from owning it personally helps offset the tax on that IRA distribution.
Okay, so what you're saying, this is a great point, and you knew exactly where I was going to go with this. What you're talking about is, just to very quickly recap, is that you've got all this money in your IRA. You don't have enough personally to buy the rental property or whatever it is. So, but you at least get a down payment so you can qualify for a
reasonable loan.
A reasonable loan on the property personally. And then once that's all set, rather than you paying out of your own personal pocket the mortgage on this, the loan, you just use the IRA. You take a distribution from the IRA to pay that loan off. That way the IRA is financing this venture, but you still own it personally. Did I encapsulate that correctly?
Yes, and because you're still using the money in the IRA, but you're using it effectively, efficiently to maintain the tax benefits for your life. Now, what if I'm not 59 and a half, Rick? What if I don't, and I can't take money out without the penalty? Well, there is a thing called a 72T. There are ways to get money out of the IRA to be able to, without a penalty. Now, if I'm going to do a 30-year fixed mortgage, and because I'm using it personally, I can co-sign for it. I have a better opportunity to get the loan, and so I can get a better loan than I would have in the IRA. And so now I'm going to get the loan, and I'm going to figure out, okay, I have X amount of dollars in my IRAs. So I'm going to take a 72T payment, which is what they call a substantially equal payment plan, and I can take a certain amount of money out every year. I've got a 30-year fixed payment. I've got a fixed distribution from the IRA. I have to take, now with the 72T, maybe that's something we should talk about someday. Once I start it, I have to maintain that same payment until I'm at least 59 and a half, and it's been 5 years since I started it. So if I'm 45 when I'm doing this, I've got a fixed mortgage for 30 years. I'm going to be 59 and a half before that mortgage is gone. And heaven forbid I have to sell the property or want to sell the property before I get to 59 and a half. Well, I'm going to be stuck taking a payment from my IRA for a couple of years. But that's the way to do it. That's a much more efficient use of the money, a more efficient way to buy it. And I get long-term capital gains. I get current depreciation. I get to keep all the wonderful benefits of owning real estate if there are those. I'm still a landlord, but I'm still using the IRA money.
Well, and if you wanted to use it personally, you could. You could use it, you don't have those rules that you have when the IRA actually owns it. Now, you mentioned the 72T and all that stuff. That does, as you said, kind of come with its own rules, and there are some restrictions and things like that, and there are some risks in doing that.
But those rules are a lot few and far between than the rules of owning real estate inside of an IRA you have to deal with.
Well, that's for sure. That's for sure. So I hope I've dissuaded people from doing this.
Well, we're not trying to dissuade you from real estate if that's the issue, but let's find a way to use the IRA properly, efficiently,
if you
to
have
do what you want to do, rather than now they say, well, the tax deferral is the greatest thing in the world. And tax deferral is great and all that, but sometimes some of the best examples I've seen of tax deferral come back to bite you in the backside. Many years ago, there was a presidential nominee from Utah, and fairly wealthy individual. And his IRA was reported, I have never confirmed this, I don't know this for a fact, to be very large. Like I've heard $100 million. And it came from the fact that supposedly he bought a startup company inside this IRA that he had, for like $1 million, and it turned into $100 million. The startup just ballooned. And because there was so much money there and because he was rich, there was certain political people that were saying, look, that should never be allowed to happen. That's just horrible that he is allowed to defer the taxes. He's never paid taxes on that $100 million. No, he hasn't, but he's going to, and his family is going to.
Or someone will.
It would have been so much better to buy that startup personally than inside of his IRA and not defer the taxes, because then when he sold it, he would get long-term capital gains treatment, or if he kept it, he'd get step-up in tax treatment, and it would not be part of his required minimum distribution going forward. He could do anything he wanted with it. So I think that was just not a good idea to put it in there, but people were bagging on him because he had so much in tax-deferred money. At that point, that tax-deferred money just became a tax nightmare for him.
Yeah,
it wasn't a benefit. That was not good.
It's good to have a lot of money, but given
the choice of having that and not having anything, okay, I'll take that, and I'll pay the taxes and complain and bitch and moan all the way to the bank. But if I have the option of having that personally or having it in my IRA, I want it personal.
Now, quickly here,
that's a better deal. Same with the real estate I'm thinking about.
Very quickly here, because we don't have a lot of time left in this episode, but you mentioned real estate can be, for the right person, a good asset to own. And I would put it in the alternative asset class. If you would,
real estate, being a landlord is not for everybody.
No, but give us the reason why somebody may want to.
Well, because you can use leverage to your benefit, and especially if you've got a network of people. Where I've seen real estate work exceptionally well is where you've got a network of friends. Maybe you're a contractor, and you've got a network of friends that also do real estate, and so you can have your plumbing friend help you out, and you're an electrician, so you help him out, and so you're not spending a tremendous amount of money. But it's also a matter of the property you buy and the tenant that you get. I mean, I've seen it where two people buy very similar houses next door to each other, and with similar amounts downtown, similar purchase price, similar, everything's, the same. Loans are the same. Down payment was the same. Everything, the cash flow, rents are about the same. The difference is one person had the tenant from heaven, the tenant that basically treated it like it was theirs. They took care of it. They paid on time. They didn't break things. They didn't call you at 2 a.m. because the party was going on and somebody stuffed a toilet roll down the toilet and it's backed up everywhere. And then there's one next door who is a tenant from hell, and they're late all the time. You're chasing them for the money. They're nitpicking on everything. They're complaining, and they break things, and you're always fixing it. And even without those, maybe the house on the right was maintained through the years and been upgraded, like new piping and things like that, where the house on the left wasn't, and now you got to repipe and do other things so that you couldn't even see when you bought it. So there's a lot that goes into it, and some people are just made for that kind of deal. Some people are not.
Yeah. Well, yeah, and I think the older you get, the less likely you're going to want to do that.
And I've seen that where it was a good investment for somebody. Maybe they bought a place, and they used 1031 exchanges, and they got bigger and bigger over the years. And they've got this place, it's a house down in La Jolla that's renting out for $10,000 a month. So it's still cash flowing well, but it's worth $5 million. And so the cash flow isn't huge, but they're just tired of it, and they don't want to have it anymore. But they know if they sell it, they paid $200,000 for it, and it's not worth $5 million.
Wow.
And they depreciated that, and so they know if they sell it, they're going to lose $1 million or more to taxes. And they're like, I'm really tired of doing this, and the cash flow is so. But if I stop managing it, which is where the problem comes in, then I lose even more of the cash flow with the property manager. And then I'd really like to get rid of it, but I can't. And they end up just sucking it up and holding on to it until they pass away, and then their heirs get to enjoy the step up in basis and they can sell it.
Well, there are upsides and downsides to
there's good and bad to everything,
and certainly, but
except for this podcast.
What are you saying? There's
no bad side.
Okay, good. Okay, I wasn't sure where you were going.
I hope,
but I thank you for that. Yeah. Well, and this is why I wanted to talk about that, because there's still talk about real estate, and real estate obviously goes in cycles, and it can be used, as you said, as maybe a non-correlating asset here and there to help.
Oh, sure.
But real estate, I want to make clear, we're not telling people you have to buy that you should buy real estate. This is a decision that you need to consider with your financial advisor, because you gave us a lot of reasons, some reasons to, and maybe more reasons not to.
No, it's a very individual decision.
Yeah, it is, and just do so with care if you're thinking of doing this, because when we're talking about real estate, we're not talking about your primary residence here, which I think obviously that's the real estate most people own, is their primary residence. We're talking about an investment property, something that's outside of your personal use. And yeah, it's just like any other alternative investment. It's something you need to very carefully consider. Professor Plum, doggone it, we're kind of running out of time. I mentioned just non-correlating asset. Can you just explain what I mean by that in like 60 seconds or something like that?
Well, a non-correlating asset is anything. It's basically, when we're talking about what is the main correlation, it's what the stock market does. So the idea is a non-correlating asset moves independent of what the stock market does. And so if the stock market may be going up right now, it doesn't necessarily mean that your investment is going up or down. They don't correlate with each other. The stock market could be going up, you could be going down. The stock market could be going down, you could be going up. And that is actually a negative correlation. So a non-correlating asset is where news that affects the stock market does not affect the value or the rent or the cash flow that you're receiving from your investment. It used to be in the past that stocks and bonds were kind of discorrelating, but lately when bonds are up or stocks are going up, bonds are going up, and so it's a little bit different game. But so it's basically, you don't want everything to have the same movement at the same time. Just because, especially when the market's down, obviously if you can get everything to move positive at the same time, that's fine. There is no problem with that. But if you have that kind of a correlation, then you have everything going down at the same time too. And we try to avoid that.
Yeah,
So,
the idea is to say, well, the stock market is going down. Let's say, it's down all year and it's been really bad. But what has helped me in some respects is this other asset that I own, whatever it happens to be, that when the market is down tends to go up, just historically, and that's kind of what you strive for. And when we talk about non-correlating assets, that's just something that. I don't want to throw out these terms without people understanding what it is we're talking about. Maybe we do. Maybe sometime we do a podcast on non-correlating assets. Oh, wait a minute.
okay.
Just me saying that sounded really dull.
Yeah.
Yeah, I think we'll skip that. We'll find something a little bit more exciting. If you want to know more about this kind of stuff, and if you need more reasons not to buy real estate in your IRA, or you want to talk about, something like this, some type of investment like this. Is it right for you? And again, you need to discuss this with your advisor, because certainly these kinds of things are not right for everybody. But you can talk to the advisors at Lucia Capital Group. Give them a call, 800-644-1150, 800-644-1150. They talk to people about things like not just real estate, but other types of investments. And it may be totally wrong for you. And if it is, they will tell you that. 800-644-1150. Go online, find them luciacap.com, LUCIACAP.com. We actually do have some videos and some blog posts on real estate and things like that. You can check those out, again, at luciacap.com. Don't forget to subscribe to this podcast. Always subscribe to this podcast, Apple Podcasts and Spotify. Make sure every single episode is downloaded to your device, and listen to every episode, because I do say that you're going to be a little bit smarter, I believe, after hearing each episode. And I feel a little smarter sometimes. Why do you think I've gotten smarter in this over the years, Professor Plum? It's just hanging out with you guys.
You're a sponge.
I
soaking
am.
it in.
That's me. Out of time. For Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. Thanks for listening, managing your financial future. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material concerns tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time without notice, and its accuracy cannot be guaranteed. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. 401k plan information used is obtained from sources believed to be reliable as of the current date, but no representation is made as to its accuracy and completeness. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. Any other individual or company mentioned in this podcast are not affiliated with or endorsed by Lucia Capital Group or LPL Financial. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.